And for commodities market update, here is Nosike Nwajide, one of the research analysts with Financial Derivatives Company. Good morning, Nosike. Thank you for joining us.
Always my pleasure.
Well, you had projected 12.95% for the inflation number. We are seeing 13.22%. That's quite high. Are you alarmed?
Yes, it is. I mean, it's alarming. I mean, we and probably every other analyst out there got the direction right, but the magnitude, the 40 basis point jump, I don't think anyone saw that. Anyone saw that coming. With the trend, obviously, this is the 12th consecutive month of an increase in the headline index, but it's also the food inflation has been rising for much longer than that. And the biggest factor in this jump was food inflation. Obviously, all the other sub-components of inflation also rose. The core index, even urban and rural inflation, were up. But food inflation, if you take into cognizance that about when we had the planting season, sometime in early March, April, when the lockdown restrictions started, a situation where farmers couldn't plant as much as they wanted to plant. So you can only harvest what you plant. So now when we think of the harvest season, you have less output than you would ordinarily have. You have the impact of less than what you would call typical amount of rainfall during the planting season. So that affected output in some areas. Then in some areas you had floods that in northern states where you plant rice, some other cash crops, you had as much as 25% of output being decimated. So that has impinged on the supply of food at this time. Then you have a situation where there's as the economy opens up, as the economy resumes, there's increased demand for food.
So we can say that there's a correlation between the reopening of the economy and, of course, the gradual increase.
Yes.
Rather, the increase we have seen. Well, this one now is not a gradual increase. This is a spike.
It's a spike because there's an increased demand for food from retail and even institutional demand, so to speak, from schools partially reopening, from hotels, restaurants, and and all whatnot. So of that increase, the increase in food supply from the harvest season hasn't matched the increase in demand. So that's where we're seeing the spike. I mean, in the coming months, we will see the effect of exchange rate weakness, increased logistics costs, higher PMS pricing, higher electricity costs as well. But for now, it's just the impact of higher demand than anticipated.
All right, now, so with inflation rising to 13.22%, that's in August, and then we've heard the central bank project inflation rate at 14.5% by the end, of the year. What will the average rate of inflation be in the fourth quarter, considering all of these variables that you have mentioned?
Initially, when the CBN came out with its forecast on Friday, most people thought it was a bit outlandish. But given the numbers that we've seen today, it seems even more likely
that we'll get more than that.
That will probably get even inflation figures higher than that. So I mean, its forecast was based on deficit financing and all the liquidity that is associated with deficit financing, as it had to meet. Federal government has borrowed so much to meet obligations for healthcare and palliatives for the COVID-19 pandemic. That, and in addition to there's a weaker exchange rate. So the food inflation, we sadly import some of the food a lot of the food that we consume, quite frankly. Then we see lower interest rates. The CBN recently slashed its savings to 10% of MPR. So people have less incentive to save, which will increase the marginal propensity to consume. That should increase consumption in the coming months, which would have inflationary pressures. If you take that, add increased PMS pricing, increased electricity costs in the coming months, that should get you to more than 14.15 by year's end.
Right, let's look at the core inflation, which is inflation minus seasonality, still on the rise. Why is it where it is?
Okay, if you remember, when the lockdown restrictions were implemented, transport costs rose, not because of increased price of PMS, but social distancing on buses. Yeah, so the buses had to be, if I carry less passengers, or I would need to I will need to increase my prices to, make up for the lost revenue, so to speak. So in time, when we saw increased PMS prices, that added to increased transport costs. So increased logistics costs has been the biggest driver of core inflation so far. And it's that now that we have a liberalized pricing for PMS, if oil prices trend lower, that could trend downwards in the coming months. But if they trend higher, then we'll see higher core inflation in the coming months.
Now, with these numbers that we've seen, next week the Monetary Policy Committee should be meeting. How do you think this will, shape the direction of your decision?
I think these numbers favor a hike in the MPR, but if you take into consideration shrinking GDP growth, the unemployment figures that came out for the first time in quite a while, we saw really poor, really terrible unemployment figures. If you take those two into consideration, we think it's our prediction that the MPR will hold, will maintain status quo for at least the next. They want to see they've already made a projection as to the inflation trend that it will get worse. We want to see what we can do with growth and unemployment. Those are the primary, those are the front burner issues at this time.
Now, the key mandate of the central bank, of course, is price stability. Now, let's look at Ghana. Ghana has kept its interest rate higher than the rate of inflation sometime. And yesterday, Ghana reported a lower inflation rate. And of course, Ghana is also expected to grow positively in 2020, whereas Nigeria is expected to record negative growth. And Nigeria last time brought down its core interest rate, and inflation rate has been on the rise. Now, does low interest rate lead to positive growth? If so, why is it not so in Nigeria?
I think the major factor is inflation. Inflation above 12% is growth retarding. Anything above 12% is growth retarding. We're at 13 points, above 13% now, projected to get to 14. So inflation, that's high inflation at 13%. Anything above 12% is growth retarding. If you have that inflation that high, you would need to have interest rates up to a certain level to attract foreign investment, whether FPI or FDI. You need a stable exchange rate. But the major issue is inflation. Right now we have a negative real return, while in Ghana, the return on investment is positive. So all those factors come into consideration. If you have inflation as high as 12%, it's hard to encourage growth. Anything above 12 is growth retarding. That's just what it is.
Okay, let's look at the export commodities. First, we have oil. Brent has fallen by 11% from $45 per barrel in recent weeks to below $39. What is responsible for the fall, and what do you think will be the impact of the meeting of OPEC review production quotas? Okay,
OPEC meet on Thursday in 2 days' time. Yeah. And the background to this meeting is that the cut from 9.7 million barrels a day to 7.7 million barrels a day hasn't exactly given the results that they thought it would. The major issue is that global demand hasn't risen as quickly as OPEC or OPEC Plus thought it would. There's a resurgence in COVID-19 cases across the world, and that's impacting how the market is viewing the market's outlook for prices in the coming weeks. OPEC is looking to basically the signal it's looking to send at the end of this meeting is one of unity and a common ground, protecting its common cause and hoping to send a signal to the market that, hey, look, we're willing to do all it takes to prop up oil prices, given that just a couple of weeks ago, Saudi Arabia, who is like the de facto leader of OPEC, was cutting prices just to attract buyers. We see that it's just past the US driving season, and oil prices didn't really respond to that, which it's typically during the summer every year, we've seen there's that premium, or small $3-4 spike in oil prices because of the increase in demand as a result of the summer driving season. In India is the third largest consumer of oil. Consumption is about 20% lower than it was this time last year. So all those factors are conspiring to drive the demand outlook lower. And for supply, from OPEC members like the UAE, the United Arab Emirates, are typically are allies to Saudi Arabia and always conform to or comply to their quota. They are currently producing about 20% higher than they ordinarily would. There's a situation in Libya going through a civil war, and it appears that it's projected as soon as the war stops, they are currently producing about 100,000 barrels of oil a day. They should rise to about 1.1 million barrels a day in about a year's time. So that outlook is, all those things are conspiring to dim the outlook for oil prices.
Okay, let's look at cocoa. Whilst we have seen cocoa output and harvest spike in Ivory Coast and Ghana, Nigeria has witnessed a fall in output. Is this because of the border closure or the increased price these two countries are paying their farmers?
Okay, on one end, on our end, on Nigeria's end, the major factors weighing on cocoa production are inadequate financing and yield per hectare. I mean, Nigeria has bigger farmland than Ivory Coast and Ghana, but our yield per hectare is struggling. It's about to, output for last season was about 245,000 metric tons. In Ivory Coast, it's over 4 million tons. Ivory Coast and Ghana together account for about 65% of the global cocoa supply. So together, about a year ago, they came together, 2 years ago, actually, they came together to form what you would call an OPEC for a cartel, an OPEC for cocoa, if you like. They put a price floor about $2,600, and they want to give their farmers what they call a living wage. So there's a premium of $400 per metric ton on that price. So the market took a while to adjust to this, but I mean, it's supposed to kick off on October 1st. So if you take into consideration what they are planning to do and how they intend to go about it, they intend to coordinate their activities, they intend to do research together and build even storage facilities so that, the fluctuation in prices, they can weather that storm. Storage, the real money in cocoa production is actually in the secondary processing, not even primary process. The secondary process is where about 80% of revenues. That's where the big chocolate makers make all the money. And that's where Ghana and Ivory Coast are targeting. So with this, they coordinate their activities, they build warehouses, they store, and they do research into how they can, increase secondary processing output.
Now, how would all of these impact Nigeria's commodity prices?
Well, the major factor affecting commodity prices going forward is actually the liberalized price of PMS. Which comes down to the price of oil. If oil prices go high, transport costs will rise even further, and we would have, given the increased demand and limited supply, we'll have prices rise even further.
Okay. Thank you very much for your time, Nosiki.
Always my pleasure.
Nosiki Onwajide is one of the research analysts with Financial Derivatives Company. All right, just before we get to Temple, let's again take a quick look at the August inflation released this morning by the National Bureau of Statistics, of course, which rose to 13.22% year on year. This is 0.40% points higher than the rate recorded in July, which was 12.82%. On a month-on-month basis, the headline index increased to 1.34%, 0.09% higher than the rate recorded in July. The urban inflation rate increased to 13.83% from 13.40%, while the rural inflation rate increased to 12.65%. On a month-on-month basis, the urban index rose to 1.42%, up by 0.15%. From 1.25% recorded in July, while the rural index also rose to 1.27%. The composite food index rose to 16% compared to 15.48% in July. On a month-on-month basis, the food sub-index increased to 1.67%, up by 0.15% points from 1.52% recorded in July. This rise in the food index was caused by increases in prices of bread and cereals, potatoes, yam and other tubers, meat, fish, fruits, oils and fats and vegetables. The core inflation, which excludes the prices of volatile agricultural produce, stood at 10.52% in August, up by 0.42% when compared with 10.10% recorded in July. On a month-on-month basis, the core sub-index increased to 1.05% in August. This was up by 0.30% when compared with 0.75% recorded in July. The highest increases were recorded in prices of passenger transport by air, hospital services, medical services, pharmaceutical products, maintenance and repair of personal transport equipment, vehicle spare parts, motor cars, passenger transport by road, miscellaneous services relating to the dwelling, repair of furniture, and paramedical services.